Hey, you guys, how's it going?
Hi, Jen. Going well,
Hi,
thank
Jen.
Hello,
you.
thank you for joining us. Hello.
Great to be here. Thanks for having us.
Absolutely. Mark, how are you doing today?
I'm fine. Thank you for asking.
Good. You know what? Should we give it another minute or should we just jump right in? What are you guys thinking?
Up
So
to you,
cool.
Jen.
We'll follow your
You know
lead.
what? Let's just do it. I have a little disclaimer here too. I want to first thank you guys so much again for joining me today and introduce myself. I'm Jen, and this is Blockchain Banter. And seeing that we'll be discussing some investment strategies, I just wanted to throw a little disclaimer in here first. Just let everyone joining know that the topics being discussed here are not intended as investment advice, and you should conduct your own due diligence and consult your financial advisor before making any investment decisions. So, wanted to get that out there. Um, and what I really wanted to say is I think just as much as you guys, founders and developers of these projects that we are all investing in have a strategy to creating your success, it's probably smart that we as users of DeFi have one also, right? And whatever your level of knowledge or experience in this space is, there's something available to fit what your needs are at that moment. And as the entire DeFi landscape continues evolving and new strategies continue emerging, it's always great to just continue learning about these new strategies and allow our own personal ones to continue evolving also. So with us today, we have Charles Story and Oliver Mayer of Phuture Finance and Mark Richardson of Bancor. And we'll be discussing active versus passive DeFi strategies amidst the evolving DeFi landscape. So welcome, guys, again, and thank you again for joining me. Thank you for joining us. If I could, I'd like to start by hearing a little bit from you guys. Charles, maybe I can start with you, if you wouldn't mind just telling us a little bit about yourself. And without getting too deep just yet, give us a quick intro to Phuture Finance.
Yeah, sure. Well, I can actually speak for Oliver and myself because we've been working together for the last 5.5 years. We're like an old married couple. So we've been in the space since 2016. Prior to Phuture, we worked at a UK-based venture capital fund that was investing into the space. So we've seen many different elements to the space. We saw kind of the ICO rush, we saw kind of the IEO rush, the STO rush. And back when we were investing capital, we were investing for equity. Investing in tokens in kind of 2018, 2019 wasn't really a thing. So these experiences and learnings from having worked hands-on with our portfolio companies really led us to Phuture and some of the things that we've been building out at Phuture. So in the simplest terms possible, Phuture is a crypto index platform that simplifies your investments through automated themed index products. That's what we do, and that's what we provide. I'm really looking forward to getting into some of the applications that we're building out from that.
Yeah, I am also. Thank you. That definitely struck some interest. So you and Oliver founded Phuture together, is that correct?
Yes, we've been working on Phuture and been adding to our ever-growing team probably for the last 18 months now. We have been under development, working really hard and really building something out that was going to stand for the test of time. And I think that when we started, we had a few options. One was to get to market quickly and fork an existing protocol. We chose to design or conceptually build out something from scratch, something that we felt was unique, something that we felt was exciting and would really set us apart from the rest out there. And that's what Phuture is in our view.
Amazing. Thank you so much. Mark, if you wouldn't mind just introducing yourself and giving us a little info on Bancor.
Yeah, certainly. Yeah, so my name is Mark. I'm the product architect at Bancor. And Bancor really, I think, is sort of best understood as a generic liquidity solution. So, Bancor started its role in the world, I would say, with community currency experiments. And these actually were even before Ethereum, right? And so some of these weren't even cryptocurrencies; they were just community currencies, the regular paper-based version. And it was kind of during that experience that we became aware of liquidity problems between these new types of currencies. And so it was only with the launch of Ethereum that we saw a way to establish a new mode of exchange that didn't require a private market maker to evaluate how two different currencies should be valued. And so Bancor was created as a way to create markets automatically, hence the name Automatic Market Maker. And it has been on Ethereum since the very early days, and still exists to support all of these new cryptocurrencies that we see being developed and introduced by other teams. So what makes us kind of unique within the AMM space is that we offer single-sided liquidity provision where the protocol itself provides 50% of the liquidity. And this is extremely important when we're having a look at some of the challenges to getting liquidity bootstrapped by brand new token teams. So for example, if you are a new project and you've maybe had a little bit of seed funding, or maybe you've got your own capital and a token that's associated with your project, you often have to either commit some of those early funds or some of your own capital to the early liquidity for that token, and before people can use it and exchange it for other things. And if you don't do that, then you've obviously got more money to pay things like the overhead costs of managing the product, and paying for new developers and things. But it means that the illiquidity of your token makes it almost impossible to interact with. So there have been two major solutions developed to sort of address that poor liquidity problem. One I would say is things like liquidity mining, and bonding is another one that kind of rose to prominence just earlier. And both of these things kind of are supposed to achieve the same result, which is that your community can bootstrap the liquidity for you. And unfortunately, in both of those cases, what has been discovered is that type of incentivized liquidity provision is both expensive and unreliable. And so it's not really a suitable solution to long-term liquidity support for a project. And so for what Bancor is trying is a completely different type of approach, which is that we still have the liquidity pools open to community participation the same way that all of these other AMMs do. But we're also having a very special focus on teams and project founders themselves, who tend to see the value in being able to provide single-sided liquidity from the get-go and establish sort of arbitrary amounts of exchange capital without having to part with their own development funds and things like that. So that's really just one aspect of what we're doing, but I think is the most important one for this call, because I think both Oliver and Charlie have, as a new project, have, seen what Bancor has to offer and have decided to adopt it as kind of its de facto liquidity solution. And I think that is one of the things that is special about Bancor, is that we do have this capacity to develop meaningful collaborations with token teams and project founders that way.
Thank you, Mark. So you touched on a couple of the pain points. One of my questions was, what pain points in DeFi, do you guys find yourselves solving? And you answered that quite a bit for Bancor. I want to give Charlie and Oliver a chance to really kind of expand on indexes and what solution, they're offering to existing pain points in DeFi.
Yeah, I think, Phuture is really designed for the crypto curious. That's how we like to define it. And these are intermediate crypto investors. They maybe they have ETH or Bitcoin in a Coinbase account, and they're looking to take that next step into the metaverse, GameFi, DeFi, or any other subcategory of crypto, and it can be very daunting for those people who are trying to make that first step, and they're really kind of becoming more and more interested in crypto. But the amount of research, the different tokens that are constantly popping up, it can be very daunting for the early investors. So what we're trying to do is really simplify that process through passive index products. So we can come with our products on market, and these investors can invest into a safe, for example, a top 5 DeFi index, and this will essentially allow them to answer a much more simple question than instead of asking themselves what token should they buy in this huge universe of tokens, they can just say, well, do I think that DeFi as a sector is going to be higher or lower than it is today in 5 or 10 years time? And that's a much easier viewpoint, and something that you can actually have a more meaningful opinion on, rather than trying to get into the details of each individual token. So that is the exact pain point that Phuture is trying to solve. It's trying to be an easy on-ramp for the increasing number of mainstream users that are coming into crypto from all angles. This is not just for us. We're going to be launching products on Ethereum. We're also going to be launching products on Avalanche. We've just recently announced our partnership with Colony to bring like the Colony ecosystem index, and that's going to be the first major index on Avalanche for that ecosystem. So that is, in a nutshell, the core pain point. And I think, just going back to what Charles touched on with our previous experience, when we was helping our portfolio companies during that time, it was all about how can we obfuscate the pain points of crypto so that people can get the benefits without actually having to understand how to use the technology. And that that finds itself into many different aspects of what we're doing. So if you look at from the wallet sign up process, we're looking at ways that we can allow people to come on board through just a Gmail account, and just really simplify that process for them. And then when it comes to the wording that we're using on the platform, it's something that they'll be more familiar with if they've used a traditional investing platform like a Robinhood, for example. And as well, I think we've taken a lot of time to build the right type of interface and branding that feels familiar but feels safe. And we have that going throughout our application, which we're really excited to launch. So happy to dive in further on any of those points, but that's the key problem we're solving.
That's a good point. And just to kind of follow up with Oliver's point there, we really put ourselves as the customer. Is coming into crypto, wanting exposure, and it's quite daunting. Like buying Bitcoin and buying Ethereum is pretty simple now, but let's say you wanted exposure to DeFi. To gain exposure to that, you're going to have to go a little bit risky. You're going to have to start using some of the decentralized exchanges out there, trying to figure out, what are the top 10 or top 5 DeFi assets. And then you have to actively manage those, right? And you're now looking at, the management of portfolio. It takes a lot of time. You got to know what's going on, what's happening. So this is a way to really get rid of all of that and make it really, really simple. And that's what we're all about at Phuture, is simplicity. And everything that we've done and been building, not only with the application and the feel that Oliver was talking about, the branding, it's all very, very simple. And that's really important for us. We believe that to gain traction within the space, we have to make our product as simple as possible for as many users as possible as well. And we really think about that a lot.
It seems like Bancor and Phuture are both really simple to approach, like that crypto curious, with Bancor having its single-sided staking and impermanent loss protection. It kind of takes away all of that heartache and pain from learning how to become a liquidity provider and balance that out. And then with Phuture, it's like you can just invest in this basket of assets. Now, who creates those indexes? Who comes up with these different options for the users?
So we create the indexes, us with the work with our partners. We work to create a rigorous methodology for each index, so that our goal ultimately is that we're retail focused, but we want to broaden that over time, and we want to make sure that the products that we are creating in the beginning have the correct, the right rigor in terms of how they're weighted, how those assets are determined. So there's a whole raft of, total inclusion requirements that we go through for each asset that we're going to include. And we manage those indexes ourselves. So a bit about the architecture that Phuture has. It's unlike a traditional, maybe on-chain asset manager, where the fund manager has total freedom in terms of what they can do asset-wise, weight-wise, and even being attentive to the index, how often they rebalance and things of that nature. And I think that one of the things that has been obvious is that in order for those types of products to really take off, the company that have created them really needs to back the fund that they've created with their own brand. Lots of sort of third-party community-driven index products haven't really taken off because you can't trust this random 0x address that's managing the fund. Phuture looks to minimize that trust even more by essentially creating bounded strategies. So when an index fund is launched and created, it follows a specific strategy. So if it's a tracking of the top 5 tokens within a specific sector, there is no way programmatically that we can start buying an asset that's completely outside of that sector and doing things that are outside of that strategy. And so by bounding it, the beauty of it is that you don't have to trust us. You just have to trust the smart contracts that we've created, and we manage the index. So we have a keeper system that rebalances based on the methodology. So if that's once a month, we will rebalance the index once a month, and those orders will be created on the smart contracts and executed. Depending on the size of the order, hopefully in a single day, but also over a course of several days if we have to tranche those orders. So that is the sort of underlying component of the Phuture protocol. The interesting part is that we've actually created this to be permissionless, but we felt that, and it can be permissionless from day one, but we felt that the right way to launch this is actually to create our own set of products and limit the number of products that can be seen. I think often too much choice is actually negative for the user experience. So if by limiting and creating high quality indexes, we're able to kind of steer that growth in the near term, and we always have the option, should we need to sort of open that up. And I think that becomes more of an attribute on cheaper chains. I think right now on Ethereum, it'd still be too expensive for the majority of people to run an index properly, and we don't want to have indexes that kind of get created and forgotten about. So that's how we view the architecture that we've created.
I have 2 thoughts to that. It sounds like everything on the back end that you're doing, you are making it really simple, but you are doing everything that an active DeFi, user would be doing, and just making, here are your options. We've done the research, we've done all of this, and I think that's a beautiful thing. I have a question for both of you, well, all of you, I guess, for Phuture and Bancor. Charlie and Oliver, you mentioned that you came from a venture capital fund, and you guys both kind of mentioned who your your target audience is. You had mentioned retail users. Do your users include venture capital firms or also and pension funds?
So the short answer is eventually that's the target. With any asset manager like Phuture, it's all about driving AUM into our products, and that's the reason why we take it very seriously in the sense of how we actually structure our indexes, because I think that you could go down the road where you have an index that perhaps is community voted on, or isn't necessarily structured in a very rigorous way, and then you kind of run into problems further down the line when you're trying to get more institutional adoption. And so that's been really key for us. We're driving that from the very get-go. All of our index will have a full methodology that people will be able to see, so that once we build up our traction on through retail channels, we can then approach the larger institutions who are invest larger ticket sizes, and we have all of the necessary rigor that they would need in order to move forward with that.
We're having conversations actively at the minute with institutions, very preliminary, and they're just really interested to see what we're working on, how it works, And we believe having those conversations now is key. It's a long process. We understand that. We're very patient. We've been developing and building out Phuture for a very long time. But as Oliver mentioned, it's about targeting each of our market segments correctly, executing upon that, and then building up to those larger ticket sizes as we grow and build ourselves.
Really well said. Mark, what about you and Bancor? What have you found?
With regards to things like pension funds and institutional adoption?
Yes, like target
Yes.
audience, the majority of your users.
I would say that the target audience today, or the main demographic that we service, is definitely the DeFi crowd, right? It's people that already have MetaMask accounts, that already know a little bit about interacting with smart contracts, that have already chosen a handful of tokens that they like to work with, and they already maybe know about liquidity provision, that kind of thing. We're hoping that that's going to change a little bit, similar to what our guests from Phuture have said. We are sort of rebranding and focusing our energy on making Bancor 3 as simple and safe as possible. And we think that as our community grows with people that have slowly learned about impermanent loss the hard way, if we can maybe say it that way, that a lot of people are looking for a more suitable liquidity provision product that they want to interact with and feel secure using. So the community base is always growing, but it's not our long-term vision necessarily that that will be exclusively catering to the individual. I think that it's possible, and that we should always be thinking about things like institutional involvement. On previous AMAs and on podcasts and things, I've often pointed out that because of Bancor being headquartered in Switzerland, we actually have a fairly close relationship with the Swiss regulator, and with a handful of private banks. And I've been on some of those calls before, and it really does seem like there is a huge amount of demand coming from the institutional side. But I'd say that there is also this kind of fear of DeFi. Maybe not in the sense that they don't trust it, or that they think that it's bad or something like that, but that the regulatory climate is so poorly defined, and they don't really know what they can and can't do. And I think that everyone is kind of waiting patiently for the final word on whether or not DeFi is something that's considered vanilla in its current status, or if there needs to be some minor changes made, especially with regards to things like KYC or KYB, and then they can start getting involved after that. But yeah, I think that in general, our user base is still the DeFi individual. We do have a handful of collaborations with other projects like Phuture, who are providing liquidity with Bancor directly. But I do think that as a passive earnings product, that it is extremely interesting to institutions and also high net worth individuals that have a huge amount of capital just kind of sitting idly by, that could be used to support the cryptocurrency markets and make everything healthier and more functional over time. So yeah, our aspirations are always to engage with that sort of world-changing, paradigm shift, right? Where we do hope to see some of the old financial vehicles, especially the ones that don't work very well, get taken down and rebuilt into something that's a little bit more modernized on something like the Ethereum blockchain, but it doesn't have to be Ethereum; it could be any blockchain. And for that transition to occur, we are going to need to talk to things like, pension funds and private banks and that kind of thing. Now, the reason why that hasn't happened yet, or the reason why, it hasn't happened at scale, I would say is still, because of some of these regulatory complications and everyone being fearful of what the SEC, for example, could decide to do in the near future. I think that it was an important signal when we saw Hayden Adams, get debanked within the United States, and I think everyone is kind of waiting to see what happens. Our DeFi protocol is something that the SEC considers to be an illegitimate operation, or is it just certain individuals or certain behaviors that are being targeted? So yeah, I'd say until all of this comes to is brought to some resolution and gives people closure on precisely what the regulators' mind is at, then it's been very, very difficult, let's say, to engage institutions directly. There are sort of custodial services and things like that allow us to engage with them indirectly, but I still think that that's kind of an imperfect solution. I would rather be being able to service the needs of these institutions and these high net worth individuals directly rather than through an intermediary.
You mentioned the SEC and regulators and them being a potential threat to DeFi. Now, we've also seen a recent flood of capital from active trading firms. Do you feel that they could possibly form a potential threat on the accessibility of DeFi and maybe even undermine the beauty of the system at all?
Yeah, so I think that for automatic market makers like Bancor, we are attempting to disrupt the power structure associated with private market making. One of the examples that I usually give to people when they ask about why making an automatic market maker decentralized or more decentralized is when I say that once you go through an airport and you're having to convert the currency of your own government to the fiat currency of another government, it might have an exchange rate, but it's very difficult for you to interrogate what that exchange rate is or why it is. And even then, the Forex broker at the airport takes a significant haircut off of you while you are performing that transaction. And, people think that, the fees on DeFi can be insane, but if anyone's ever had to engage with one of these Forex transfers, I can assure you that TradFi is still a lot worse. Up to, in some cases, something like a 40% haircut is considered normal. And I think that that's kind of toxic, right? I also think that these market makers generally put their, and understandably, put their own survival above the survival of the market. Which again, like I said, it's pretty hard to be critical of them for that. But it does recognize that they have a responsibility, right? That maybe no centralized entity should ever have. The ability to maintain liquidity constantly while markets are doing whatever it is that they're going to do is tricky if you are let's say a reluctant participant in those markets from the get-go. I think a really good example of this is what was happening with things like the GME stock and the AMC stock during the Wall Street bets shenanigans, last year, when people were looking at how over-leveraged some of these short options were and realized that they only had to buy a small amount of AMC and GME stock in order to to start to basically start a liquidation cascade. And this is this a market that is working well? Probably not. But it's still, there was nothing innately wrong with any of the decisions that anyone made. The leverage that a lot of these hedge funds had on things like AMC was their own decision, right? And like no one forced them to short it that far. And if someone is to realize that something is impossibly over leveraged, then that is an opportunity for them. And if they want to buy some of that stock just to see what happens when the liquidation cascade begins, then so be it. But it's unfortunately not that fair. Instead, what happened is that in order to protect some of these hedge funds from catastrophic losses, governments essentially stepped in and banned the trading of certain stocks. And I don't think that is, it's holding hedge funds and like high net worth institutions and individuals to a double standard, where normal people on Reddit basically get shafted. But if you're wealthy enough and rich enough, then the markets can be paused and reversed and manipulated to your own advantage, right, or to the advantage of people that have more committed to it. I think that AMMs is the perfect way to get around this, because the AMM model, it doesn't know about shorting and leveraging and things like that. All it knows is that A times B equals K. And it will keep making markets that way forever. And so in that way, it's the perfect unbiased system that doesn't know or care about any political or financially motivated strategy that should change the way that it functions. It will just function the way that it was programmed to all the time. So yeah, I think that even though that this is, I think, a very positive thing for the market overall, if you are one of those institutions that is constantly being bailed out, from your own bad decisions, then AMMs are a threat, right, to that kind of, protected environment that you've been living in. And I think that is constantly threatening to change the. These guys are constantly trying to take back some of that power in DeFi.
I think you brought up a really good point there, Mark, which was an open or truly open financial system. And that's something that we really believe in at Phuture. We believe in an open financial system for everyone. And with the index products that we're launching, they're available to everyone. All you need is access to Ethereum or USDC to be able to participate and get exposure to one of our products. And that's not the same in traditional finance. People are restricted by what country they live in, and that's not their own doing. You don't get to choose that. And there are a lot of restrictions for people outside of kind of Western economies. And that's something that's really important to us, that we can unlock and provide our services to everyone who has internet connection. And that's really just kind of build up of what you're saying there.
So you guys are, speaking on traditional financial system, right? I think that is somewhat, like a broken traditional financial system was the inspiration initially behind DeFi. Like, let's take this and let's fix it and let's make this an even playing board. Did you, when you were building out Bancor, you were building out Phuture, did you look at the traditional financial system in that same way and look at what concepts worked and carry them over, and what criticisms you had and created and implemented solutions for? And do you still continue to do that now?
Because I don't come from a financial background, I'm still sort of learning about some of these, TradFi products and concepts. But I'm also sort of I like to reduce everything down to its sort of atomic components. One of the things that I've sort of come to the conclusion over the last year is that there are really only maybe two axiomatic parts to all of finance. So one is exchange, which is like a profound type of indivisible component, the ability to value two things versus each other and exchange between them while changing their exchange rate is it is indivisible, right? That is not constructed from other financial components. And then I think the other one is risk transfer, which is essentially insurance contracts, and I would lump futures markets and options contracts into that bucket. And so once you've got these two things, you can kind of build them up into lots of different ways, right? You can kind of organize them into more complex systems and use that to service some very specific need. So I think, for example, lending and borrowing is a specific implementation of both exchange and risk transfer, because really the people that are borrowing an asset versus another asset they're looking to perform a type of exchange, right? They're rarely borrowing the asset that they're providing, right? They provide something like ETH and borrowed DAI, which is a familiar example, hopefully, to everyone on this call. So there is that exchange component because you need to know how much DAI to deliver to the person. And then the risk transfer component is the sense that they are, they want to be able to go and spend this DAI doing some other activity, right? Maybe they need to pay their rent, or they need to, I don't know, maybe there's a yield farming opportunity that they're trying to take advantage of. But the risk transfer is essentially that if they sold their ETH directly for DAI, then they are no longer exposed to the ETH price, right? And so that's a risk for them that they don't want to take, because they're convinced that if they waited, they could sell ETH for more in the future. And so the risk transfer here is that if you borrow DAI instead, you can maintain the exposure to the Ethereum price by essentially coming back and rebuying it at the price that you originally borrowed against it for. And so that's one example of how these two things are combined into a single product. And I'm learning more and more that essentially all of finance is built up from these two components. So I don't necessarily mind that I don't have a huge amount of prior knowledge from the TradFi markets. But having said that, I do still learn about how these things are composed and what types of products are popular, and I also like learning about the history of finance and when futures markets became, or perpetual futures markets became the preferred alternative to things like options markets and things like that. So there's kind of some market research stuff in there, but in terms of actually designing our product, I think that I have everything that I need without necessarily having to refer to what's come before it in a direct way.
Charles and Oliver, what about you guys in Phuture?
Yeah, I think Mark put it in a very succinct form. I like the way that he said that. With Phuture, what we've done really is, we've looked at what we can take from traditional finance, and I think that one of the things that when you kind of go through the exploration process, you kind of realize that oftentimes you come back and think, actually, the way that some of the processes are done in TradFi are good. They work very well, and we're very focused on building the right benchmark indexes and building the rigor into them that comes from the TradFi space. That's where you will see that ETFs that are based on an actual benchmark. And I think when you move into DeFi, sometimes that rigor is lost a little bit, and that's for us very important. So we've definitely kept a lot of that within our products, but also when we're looking at the journey that we're going on in DeFi, I think we're still very early, and so the products that we are creating now, based on the applications that we have at the moment, I think that will definitely evolve and change, and we'll be able to tap into more and more of what DeFi has to offer as we go. But from the product building perspective, we don't really, certain concepts, net asset value, ways of valuing our products, ways of, transferring and tranching trades, and, things that maybe you wouldn't have to deal with on a, traditional finance, where you have more order book type exchanges. You have to kind of like limit your price impact when you're trading, things of that nature, that are kind of, I would say, new concepts in DeFi, but that's the whole sort of realm of trading at the moment is through AMM, so you have to be take that into account. We definitely look at that, and so when we're building our products, we take a DeFi first native approach, and when we're looking at the ways that we can bring that rigor in, we look at what's happened before in TradFi and bring that in, so make sure that a lot of the institutions that will come over eventually, as Mark says, as they get more comfortable, this is part of what makes them feel a bit more comfortable moving into DeFi.
I think one of our roles as well at Phuture is also to kind of reimagine things and to utilize the new ecosystem that we're in to the maximum potential that we can, and think of new ideas, think of new products that we can build upon what's already existing. And that's something that we spend a lot of time doing at Phuture. It's a lot of kind of open conversations of, what would be cool? What else can we build? What else can we do that's not already out there? And I think that's the exciting part of our roles at Phuture.
Yeah, I want to second that that sentiment about building sort of something new, right? Something novel. I don't think that it is the outcome that any of us want for TradFi to be recreated just on a blockchain, right? And for that to be successful, right? For us to actually develop something new and interesting, we do need to be creative enough that we're not just saying, okay, how can we bring this already existing tool to blockchains? I think that it's better to imagine new tools than to just sort of build facsimiles of them.
Okay, so I have another question then. You guys had mentioned a couple of times like a truly open financial system, and now you're talking about building something new and novel, right? And one of my questions was, how do we create a system that continues to lower the barrier to entry and welcome new users? And how can passive strategies survive among the highly technical retail users with the technical expertise and time to actively manage a strategy or portfolio?
I think with regards to onboarding users, it's about making the process as simple as possible. And I was looking at a really great statistic the other day, and it was looking at fintechs and the amount of clicks it takes to open an account. And I think that with with a HSBC or someone like that, it was like up to 70 clicks to open up an account. And if you look at the fintechs like Revolut in London, it was like 10. So for us, we're really focused about how long does it take for somebody to be able to come to our website and actually buy an index, and really focusing and tailoring that into making that process as simple as possible. We're even experimenting ways at the minute for users to not even have a crypto wallet and be able to purchase from the application, the Phuture application, and index, and for us to front end that wallet and be able to allow that user to move the asset into that wallet, all without having to go and figure out MetaMask and different chain IDs as well. So it's about making it really simple for the users and removing any confusing parts that are there or anything that eliminate any noise that's there as well. With regards to your second question, I think that even the highly technical traders out there will have exposure to indexes. And the only thing I can point to is traditional finance, where I believe the global equity market is worth around like $96 trillion. Of that, 18% is held in index products. There's a reason for that. One of the statistics we were looking at internally the other day was passive versus active trading over a 10 to 15 year window. And I believe it was something pretty shocking, like 96% of active fund managers can't outperform the S&P 500. So that it has a very significant role. And I believe that role with passive exposure and investing in crypto is only going to grow with the more money that we see coming in, the market returns that we're going to be seeing as well, and for capital deployment from these institutions and also from investors coming in as well. Having that as part of your core portfolio, I think makes a lot of sense, and it's something that people will be very familiar to as well. I'll let Oliver kind of fill in any blanks that I've missed there.
Yeah, I think what's happened in the sort of last 5 years is everyone's been very passionate about the projects that they've been investing into. They've wanted and been willing to do the active management, the deep dive research that it takes to really become very familiar with a project. I think as crypto is breaking new boundaries and the mainstream users are kind of starting to cross over, they are really going to want a product that is much simpler. That I like I mentioned before, you can answer those basic questions, and I think so. An index always has a place, even amongst active traders. Even if it's like, as Charles said, the core part of your portfolio, then you have a satellite of different investments that you take that are more risky. I think that's a very common approach. I think if you look at kind of what happens in the past, especially in TradFi with active management, the typical life cycle is that a successful manager, someone who's talented, starts a fund. The fund usually starts off quite small, right? And then they have extremely good returns. Lots of people pile their money in. Then they start to sort of run into, eventually at some point, like a liquidity problem. So they can't start to, you know, access the more esoteric opportunities that they have been. And so their performance starts to come down. And, you know, maybe this isn't a great sort of corollary to DeFi, but oftentimes, you know, those managers end up getting poached by other funds because they're doing so well, and then they leave, and then the kind of the performance of the fund over time is quite cyclical, where in the beginning it does very well, but then at the tail end it kind of tapers off because that, you know, they're not able to move the sort of capital that they need into the smaller opportunities that really drove that performance in the beginning. And I think that you know, in DeFi, you definitely have, you know, if you're able to automate the strategy, you can remove the kind of the active, you know, the management risk. But it's also very difficult to you know, automate a strategy which could be doing, you know, one thing, and then the market shifts and the opportunity moves somewhere else. So you know, you're always going to have some type of team behind that. But I think also the liquidity is a major thing. And so, you know, over time, the performance of these funds tends to trend towards, you know, and sometimes, as Giles said, like in most cases below the benchmark. And so I think there's always going to be a place for passive products. And I think, you know, especially what we've seen in the last sort of 5 years in traditional finances, that's really taken off. And I think hopefully from our perspective, that's a habit that's going to come into DeFi as well.
And how do you comp performance as well? You know, we foresee a world where you would comp it to the specific index in the specific sector as a relative benchmark to your performance as a trader and investor, right? So when you start thinking about it from that perspective of the benchmark, I think you can really foresee its role within the crypto ecosystems.
Yeah, I agree with a lot of the points that have just been raised. I think that things do need, like the number of clicks to start an account is a really interesting metric, and that's something that maybe I think a lot of projects need to pay more attention to. Because, you know, that's, I guess, a sort of a complexity with regards to the user experience, right? Or the user journey towards getting them from wherever they are to wherever you want them to be. But I also think that we tend to throw other obstacles in front of them as well. And there's stuff that's a lot more dangerous than just the number of clicks. So, for example, I'd say in DeFi, we often provide users with beautiful graphical user interfaces and like tutorials for how to put their money at risk, you know, and we do very little to educate them about how they're putting that money at risk, or how to make an intelligent decision while putting that money at risk. And even the efforts that are made to educate people like that, there is no effort made to guaranteeing that those users have engaged with it before committing their capital. And I do think that this is going to reflect in, you know, court decisions over the next few years. Because we don't have something like a licensing system, that there is kind of an overt, right, responsibility that the people that are building these protocols and providing the user interfaces have to the user to make sure that they actually understand the actions that they're taking, right? If we are encouraging them to do it, then I would say that there is an ethical responsibility to them to make sure that they understand why. And I think that, you know, at Bancor, we're really trying to make sure that there is no edge. You know, people like to throw around this term like, you know, like edge is something that you get for free, right? You can make a good decision, and that decision somehow just plays into your hands, and it's like a victimless crime or something. But it's obviously not true. In general, for a lot of these DeFi protocols, many have to die for a couple to survive. And I've started referring to these protocols as predatory. That they essentially will, you know, create a system that requires such a sophistication of understanding that any regular user is essentially just throwing themselves in front of moving traffic, and, you know, isn't even aware that they're doing it. And I think that this is a type of simplicity that has nothing to do with the UI, but also with the actual financial performance of the protocol that is being built. I don't think that, and I'm not against these types of protocols existing. I just don't think that they should be as superfluous, right? Or sorry, as ubiquitous as they currently are. I think that what we need is something that at the base layer makes everyone feel safe and comfortable, and that they aren't being exploited actively by someone else who's essentially betting against them. And I liken this to something like an index fund, right? And as I think Oliver and Charles have both said, 96% of hedge funds do underperform the S&P 500. And so just owning an S&P 500 index is something that some of the largest funds do, because they do feel safe just owning that thing, right? And they don't want to be actively hedging against it and managing very complex strategies on top of it. That there ought to be this thing that is just constant, right, and reliable. And that you don't need to spend a huge amount of brain power to make sure that it's working properly. And interestingly enough, that even though that thing is so simple, it does outperform the majority of hedge funds that don't, that are employing much more sophisticated strategies elsewhere. And I think that that's what I want Bancor to be, right? I want it to be the S&P 500 index of liquidity provision. The thing that is easy, the thing that is generally risk off. And you might not have that edge, right? You may not be able to find someone somewhere else in the ecosystem making a bad decision that you can then harness to your benefit, and that's fine, right? I don't want us to be constantly cannibalizing each other. I don't think that it's necessary for finance to be structured that way. And so with that in mind, I think that anytime you have to ask a user to understand some very let's say some very difficult mathematical concept or some very specific component of how finances work, then in general you should consider that product isn't appropriate for a mass market, right? If they even have to understand even the most elementary of math before committing to your product, then it's not mass market. People just want to put their money somewhere and feel safe. And yeah, if it requires active management of any kind, then I would say from a mass market perspective, that product has already failed.
Okay, so I'm trying to think of how I want to word this question here, because you guys brought up a point that I want to touch on. Maybe it's just from being a user in this space, but I feel like, you're talking about this ethical obligation to create this simple and easily accessible and understandable user face. And I feel like as the space evolves, some of these protocols, these DeFi platforms, are in such competition with each other that they're just becoming more and more sophisticated. So it's nice to hear that you're both, focused on the simplicity of it and that like crypto curious, or like just that not super, what do you call it, Mark? The sophistication of understanding, But
Yeah.
with the recent influx of institutional firms, I feel like a lot of DeFi platforms and protocols have kind of started catering to them. How do you think like you can appeal to them without necessarily catering to them?
Well, I mean, you can appeal to them. So I think that one of the assumptions that you can make with these large institutions and what you can't make with the general DeFi user base is that they understand the risks that they're taking. And so I think things like leverage is something that the fund managers you can make that reasonable assumption that they understand that that if they're taking on a leveraged position, that they're putting that they're exacerbating the risk of whatever position that they've taken. Whereas I don't know if regular users fully understand that. So yeah, look, for some of these products, I would say that it's totally fine, right? For funds looking to have that edge over each other, we are going to need, and that we should be developing some of these sophisticated products with exactly the types of feature sets that they're used to using, outside of DeFi. Things like, margin trading, but I don't necessarily think that it is that you can claim that you are pandering to that just by having it, right? I think that there is probably going to be a market demand for it, and we should expect lots of different DeFi protocols to offer leverage. It's it's another really important basal component to the way finance operates, and so it's okay to have it, and it's okay for people that are using it to lose. I'm not saying that everyone has to win all the time. I'm just saying that the people that are using stuff, we need to be fairly confident that they understand the risk of using it. So it's okay to have products that are very institutional facing, but I don't think that I don't think that that's how we get the mass market. That's what I'm saying.
I think just to answer your question there, Jen, of how do we get institutions on board or make it more available, I think it's all about accessibility for institutions. Right now, it's not very realistic that they're going to go and buy our token on X exchange or come to our platform or whatever. I think it's about being in the environments that the institutions feel comfortable in. And right now, I think that working with large custody providers that already have that client base makes a ton of sense. These are kind of like closed pools almost that the
Oh, Charles, you cut out for a minute there. Are you still there?
Yeah, I think as well, not only
Okay.
going to the custody providers, but also looking at like AV's ARC products, creating kind of a permissioned pool where they can test your product in a kind of a real-time environment and KYC and go through the procedures that make them feel safe. I think these type of things are key to bridging those initial conversations and getting some action happening as well from their side.
I want to add to that that I'm not convinced that when institutions come here that it's because that they want to buy and trade, wrapped Bitcoin for ETH, for example, or because they want to buy some DAO token or something like that. I imagine that often that they will be doing these things, but I don't think that when institutions are getting here, it's to interface with the assets that currently exist on DeFi. I think that and I hope that this isn't a profound realization for anyone, but when some of these much larger organizations are looking at DeFi as a potential solution to their financial needs, it's to bring their own types of assets, right? Then they may not be looking to borrow against Chainlink or use MakerDAO or something like that, but to use the technology of the blockchain to facilitate things like special risk transfer vehicles, stuff that regular users would never even want to know about. There may also be, ring fencing to the extent that we don't, to a much greater extent than most people would, than most people have considered so far, to the point where there are some financial instruments that can only be bought and sold by like a half a dozen entities around the world, and bringing that kind of activity into the purview of the regulator 24/7 is attractive. And also things like automatic liquidity for these types of things via an AMM rather than via a broker is also more secure and more convenient and less expensive to use. So yeah, I think that one of the things that will be a requirement before institutional adoption becomes the end game that I think a lot of industry spectators are waiting for is that we do need to see a little bit more tokenization of real world assets and financial instruments. And when those are on chain, I promise there's going to be a lot more interest in using public blockchains for as an alternative to traditional finance, for sure.
Thank you, guys. I just realized that we've already been on the call for an hour, so I want to, if you don't mind, just give the listeners an open invitation here. If you have a question for our speakers, please do go ahead and request to jump up on the floor. In the meantime, maybe I can hear a little bit about your roadmaps, what you've got going on. Mark, I know that you have Bancor 3 launching. You had mentioned that. I'm well aware of that. Maybe you can tell us a little bit about that. And then Charles and Oliver, you can tell us about, what you've got in store with Phuture.
I'm happy to let Phuture Finance go first.
Great. Yeah, so where are we at right now? We're going through our final set of audits on our code. It was really important for us to execute multiples and 3 audits on our code to make sure that the chances of risk security-wise is minimized as much as possible, as much as it can be. And after that, hopefully within the next sort of month, we're going to be going into a open beta. So initially closed and going open, and sort of rolling our platform live from there, really. So we'll be launching on Ethereum. We're working with and speaking with a few different partners at the moment to launch some really exciting indexes, which are going to cover a variety of different sectors. So that will be those will be launching sequentially after our launch. We've already announced that we're going on to Avalanche, and we have a partner there, and we're working hard on that index at the moment to make sure it's the best it can be in terms of the way we promote it and the way that we provide access to it. So we'll be moving on to Avalanche. Some of the parts of Phuture that we're excited to showcase is kind of its modularity. So, the ability to bolt on different strategies. We want to split our product hierarchy into an individual realm and also an institutional realm, or maybe a DAO realm. I think that right now the access that we can get to DAOs is much more immediate, and there's obviously a much smaller education curve that needs to happen rather than when you're going to an institution, whoever that might be, a bank or a pension fund or whoever, right? I think that's, as we've kind of discussed on the call, that's far off, but we can create products for DAOs that I think could really target their treasuries in ways that I think haven't yet been done, and people are starting to kind of talk about it. But the treasury diversification from an index perspective, I don't think is that interesting. I think taking variable risk with your treasury assets in general, unless you have a very large treasury, is not something that's super desired. I've seen some examples of it happening, but definitely from our perspective as a startup, the capital that we have is really important, and we want to make sure that we can earn an interest on it without taking risk with it. So I think there's some products that we're going to be working on that side that we're very excited to talk about as well. And one of the key sort of themes we want to make sure is, one of the issues with minting indexes is incredibly expensive due to the number of swaps you have to do. If it's a 10 asset index, it's 10 swaps that need to be done. So, for us, really important that we secure very liquid exchanges. That's why we're very excited to work with Bancor on that front for the products that we launch. Again, making sure that they're safe, that they pass all the whitelisting checks on the Bancor side. So liquidity is really important, but also making it cheaper. So moving on to layer 2, so that minting can occur on a layer 2 at a much cheaper rate. I think is going to be a key theme for us moving forward, making our product as simple as possible. From launch, taking in the feedback and recursively, innovating.
Yeah, some key points that a lot of us mentioned. What I would say is, if you head over to our Twitter, you can pre-register for the Kai Index, which is the Colony Avalanche Ecosystem Index. There you'll be subscribed to all of the other product updates that we have coming out. And we're really excited to be bringing those out. So if you want to kind of learn and have exclusive access and incentives, please sign up and put your email down there. We've got some great content there as well.
Thank you guys so much. You have an exciting roadmap. I mean, you've got did you say your third audit? You're going through 3 audits right now, then beta, and then your mainnet.
Yeah, so the last one we have going on is with C4, which is like an open beta community, and an open sort of audit community. So once that's complete, everything else is more or less in place. So we're going to start onboarding our community, and we want to get as much feedback. We want them to try and break the UI wherever they can, and we can fix everything so that when we go live, when we start driving traffic to the site, everything is in place and has already been tested. So from that point onwards, it's about innovating. We've grown our team to be able to move quickly. I think that's really important. And we will be trying to fill out our product range in both the individual aspect and also trying to provide products that for DAOs and their treasury, and how we can optimize the assets that they have and bring their capital into our platform as well.
Amazing. Congratulations on all of that. Mark,
Thank
if you wouldn't mind. Yeah, absolutely.
Yeah, for sure. Bancor 3 is entering into its beta testing period. relatively soon. So I think it's only a couple of days away right now. So Bancor 3 is pretty interesting. It is bringing back a lot of the stuff that I would say that version 2.1 it did away with. So things like non-fungible user positions, which was a necessity for the way that Bancor version 2.1 operated, is now being tokenized and turned back into a fungible composable element. This means that Bancor version 3 will have the first single-sided pool token of any AMM. And this is in the truest sense, right? If you provide any amount of whatever token you are trying to create liquid markets with, the Bancor protocol accepts all of that token as is. There is no swap into some other asset, which is usually performed by integrations with protocols like Zappa. So there is a single-sided or quasi-single-sided liquidity provider option on things like HyperSwap. But what they actually do is they sell off half of the tokens that you have provided in order to buy the other half of the pool and contribute both sides. On Bancor 3, that won't be true. Whatever tokens you're providing, all of them are kept by the protocol and used to make markets. They're not they're not sold off to rebalance the pool or anything else. So I think that's pretty special. The impermanent loss protection is getting even stronger. So whereas we used to have to wait for a 100-day period for that insurance period to fully vest, this is now being replaced with just a 7-day cooldown, which effectively means that all of these LP tokens have their fully protected valuation baked in from the instant that they are provided. The other more industry-facing aspects are things like the external impermanent loss protection policy and the ability to provide third-party auto compounding rewards. So I just got back from Barcelona. I was there for the Avalanche Summit and then for the Cello conference. I had an opportunity to meet with a lot of different projects and project founders with their own token and who had struggled with the liquidity problems on their chain. For a couple of these projects, it's been absolutely devastating to collaborate with things like Trader Joe and Yield Yak simultaneously. And this is not a slight against either one of those protocols, but both of those protocols are phenomenally good. But I think what a lot of token teams haven't realized is that when you are incentivizing liquidity provision from your community via these channels, that things like the auto compounder will be constantly selling off at least 50% of the emissions to buy usually the layer 1 tokens, so AVAX in the case of many of these conversations, in order to create new pool tokens and then compound the LM position for the user. And so over time, this generally drives the token price into the ground. And they were heartbroken, I think is the right way to frame it, that this was, people in the industry sort of just take this for granted, or no one warned them that this would happen. And so they were, generally looking for a better way. And I think that Bancor version 3 has got a really interesting combination of features that make these, that make for a much more pragmatic solution. So for example, you can still have these liquidity mining emissions for your community, and they can still be auto compounding. So you can still, actually grow your user base and incentivize engagement that way. But with Bancor's auto compounding rewards structure, there is no selling your native token. It auto compounds without having to perform this ridiculous swap and rebalance and creation of additional pool tokens. It's just it's just essentially exchanging the liquidity provided by the project in the first instance to the users over time. And we can do this via things like an exponential decay curve, which means that your liquidity mining emissions can be made to look just like Bitcoins or Ethereums. And that also helps to stave off some of the unsustainable inflationary policy that we've seen sort of plague the space for the last 12 months. But more importantly, that mode of liquidity mining also means that the whole budget of liquidity mining emissions that's provided by the team, or by the project or by the DAO, is liquid from the first instant. So if someone wanted to create, for example, a 10 million token emission profile over the next, with a decay constant over the next 35 years, that could be done on Bancor, where all 10 million of those tokens are always liquid. And this is, I think, a massive advantage that we have with regards to actually providing solutions that work, right? That actually help these token projects get their feet under them. And so I'm really excited to see how some of these things play out. Now, obviously, we've got a lot more stuff that's happening on Bancor version 3, and we've got a lot of material circulating that describes a lot of it. So I've done a lot of talking this call already, so I think I'm going to leave it there. But I think just with regards to the support that we're offering other members of the industry, I think that they should really have a look at what Bancor 3 has to offer. I think that they'll be surprised at how interesting and how useful it really is.
Awesome. Thank you so much, Mark. Thank you, Charles. Thank you, Oliver. I really, really enjoyed the spaces today. Time flew. And I wish you luck with your mainnet launch and going over to Avalanche and everything you guys have planned, and Mark with Bancor as well. So exciting times. Thank you guys very much again for joining us, and thank you to the listeners for tuning in.
Thanks. Appreciate it.
Thank you so much. Really appreciate it.
Absolutely. Thank you guys. You guys take care. Thank you, everybody.
Bye-bye.
Bye-bye.